David, welcome back. Good to have you with us. I note in your notes that you say you think the economic expansion can continue if, one, the consumer remains healthy, and two, the Fed can moderate its current aggressive stance against inflation. Well, we got a consumer report today that indicated that the consumer was not feeling particularly ebullient. And number two, why would the Fed moderate its aggressive stance against inflation in light of today's numbers?
Well, today's numbers actually met our expectations because the cost of energy and the cost of agriculturals was, exceptionally high this past month and probably has peaked. And we don't expect inflation, by the way, to come down until more than 6.5% by the end of this year. So the only reason for the Fed to actually pause is because a lot of the increases of interest rates have already been priced into the market. And right now, we already see the effect that that's having on consumer. It's having on home prices, on new mortgage applications. And if you think about it, that's already having a positive impact on the supply and demand of all other goods and services, right? When you think about it, we're seeing stores that are full of inventory. We're actually seeing Target report that they actually have too much inventory. And we're also seeing consumer demand come down. So the question is, can the Fed be patient to allow inflation to naturally subside, or are they going to crush consumer demand and cause unemployment as a way of getting to the same end?
If you have, as you say there, consumer demand coming down modestly, as evidenced by what Target said earlier this week, and other things like that, doesn't that sort of tell you that a recession is a higher than normal probability?
We also agree that it is a higher than normal probability. The question is whether or not the Fed thinks that that is absolutely necessary, right, to deal with this inflation. The critical thing to look at whether there's going to be a recession or not is actually whether or not we're going to see negative growth, actual destruction of job employment. Because right now, consumer demand leads employment. We expect employment to naturally, the heated employment to naturally come down. And if all of that occurs and the Fed doesn't raise rates more than, let's say, another 100 to 150 basis points, we think that that can be tolerated because it's priced into the market now. If the Fed, however, says we've got to attack inflation, it's way too high, the only way to do that is through a blunt instrument, which is both reducing interest rates and taking liquidity out of the bond market. And if it chooses to do that, that is a recession. And we consider, the middle of the road scenario to be about a 50% probability and recession to be about a 35% probability. And that is a high level of risk that there could be a recession.
I'm sorry to interrupt. Please finish your thought.
No, the other thing I wanted to mention is that this idea, that a recession, will be deep and long and all of that. I also think is something that everyone assumes. It definitely will have an impact on stock prices for a short term, But the fact of the matter is that from a consumer standpoint, you may see a very relatively narrow dip in the market.